Hello, everyone, and welcome. My name is Liz Prain. I'm an attorney with Moskowitz LLP. Steve Moskowitz founded this firm because he saw a need to advocate for businesses and individuals. 30 plus years later, he's still doing this alongside with his team of attorneys and tax professionals, including Cliff Capdeville. And much like Steve, Cliff began his career with a Big Four accounting firm and brings his years of tax law experience and accounting practice to Moskowitz LLP. Today, we present the Restaurant Revitalization Fund. Thank you.
Liz, thanks so much. And folks, the government has really stepped up to the plate and done something. And it's not just restaurants, it's bars and food trucks and food stands. And the government specifically left this very wide open so that they're specifically talking about lots of businesses that sell food and beverages to the public. And essentially what they've done is they said, okay, they're going to make good your COVID losses, your losses of gross revenue, the total money you take in, up to $10 million. And for most of you in this audience, hopefully your loss was under 10 million. And the government is giving you multiple bang for your buck here. And you say, well, wait a minute. Do I have to pay tax on this? No, it's tax-free. And you say, well, wait a minute. What about, when I spend the money on something, can I still, even though the government gave me this free money, can I still deduct it from my tax return? Yes, you can. This is a tremendous giveaway. Now, this law was signed into effect by President Biden on March the 11th. And this one is a first come, first serve. The government has put aside some money. And although they put aside a large amount of money, $28.5 billion, if you think of all the restaurants and bars and food trucks and food businesses, that's not that much per establishment. However, the government will give you up to $10 million, first come, first serve. So what I'm trying to say to you is, it is paramount that you be in line early enough that they don't say, sorry, money ran out. It was a great idea, but none for you. That's what we want to do. We want to be there for you on the front lines, explaining why you're entitled to this money, how to get the max, and to get it. And now I'd like to turn the floor over to my friend and colleague, Cliff Capdeville, who's going to explain to you all the details involved here. Cliff, take it away.
Thanks, Steve. This is absolutely a huge program, a huge benefit for all of the different types of food and drink venues in the United States. Restaurants, food trucks, food carts, caterers, bars, lounges, taverns, brew pubs. If you're in the food or beverage business, this is for you. You are very likely to be a qualifying business. Who doesn't qualify? There are a few categories where you're not going to qualify for the fund. This would be a government operated business, a large business, a publicly traded company is not going to be eligible for the Restaurant Revitalization Fund grant. In businesses which owned or operated more than 20 locations as of March 2020, a year ago. So this is intended for small businesses, and we'll talk about the shuttered venue grant, which is really an overlapping grant system, also administered directly by the SBA. If you receive the shuttered grant venue, you're not going to be able to double dip and get the Restaurant Revitalization Fund grant, but everybody else is eligible. I see questions popping up. We're going to get to those in a bit, but certainly the key difference here, if you were a PPP recipient, instead of going through a bank, these are going to be directly administered through the SBA, just like the shuttered venue grants were or are now. So you're going to need a DUNS number and to register on the sam.gov website. We'll talk about how to do that in just a minute. Some priorities here. If you're a woman-owned or veteran-owned business, you're going to get priority for the first 21 days. This is huge. That means that you want to be first in line. There's a lot of money. It's not unlimited. So you want to get your ducks in a row. That means you want to get with your accountant or tax attorney, get your financial statements in order, make sure all your tax returns are all done. Those are all going to be requirements to get any money from this program. Are franchises eligible? Yes, they are. They are limited, like the general program limitations suggest. If you've got 20 or more, then you're not going to be eligible. So, and that is regardless of the type. So my example here, if you own 15 Jamba Juices and 7 Arby's locations, that's a total of 21 franchise locations. You would not be eligible. You would exceed the 20 location rule and you would not be eligible for the RRF. As Steve mentioned, maximum grant is 10 million. That doesn't mean you're going to get 10 million bucks. It's a maximum of 5 million per location. And the you're going to calculate your eligibility based on your gross receipts, the difference between your 2019 and your 2020 gross receipts. So if you're established, for example, during 2019, you're going to receive a grant that's the difference between your average monthly gross receipts in 2019, it's multiplied by 12 months, and your average monthly gross receipts in 2020 multiplied by 12 months. That's going to be the maximum grant amount. If you're came into, we did get a question already. What if you were established after 2019? So for businesses that were established after 2019, you're still eligible. Your grant's going to be equal to the eligible payroll expenses minus your receipts for the year. What kind of eligible expenses are there? Well, they're what you might expect. And we're going to talk about how to coordinate your payment of these expenses with the various through the various programs. But eligible expenses include, of course, your payroll cost. Interestingly, principal and interest on your mortgage payments are both eligible. So even though that principal is adding to your equity in a property, that is a qualifying expense for the Restaurant Revitalization Fund grant. Of course, rent and utilities count. All your normal food and beverage expenses, paid sick leave, and any expenses the SBA determines to be essential to maintaining your entity. Repair expenses, you're not going to be allowed to build, expand greatly. You're not going to be able to add another interior room, for example, but any construction related to accommodating outdoor seating will qualify. What is not going to count and not eligible is, as I said, these are going to be any kind of expansion purpose expenses, adding another adding another room or another kitchen. Those are not going to count. What is the covered period? So the covered period, it's scheduled to end at the end of the year, although as you know, a lot of these programs have been extended. So would not be surprising to go beyond December, but now with the vaccine and venues opening up, it could be that that this is it. The 2021 is really it for this particular grant. We got the authority. SBA has the authority to extend it for two more years, but there's a set amount of money now, and as things turn it around, it is possible that this will not be extended. So spend your money. This is going to be a theme throughout the presentation. You want to coordinate the various program expenditures, but the goal would be to spend this money if you can. If you don't spend this money, you're going to be required to return it. So it's a little bit different. If you had the PPP, you didn't spend it all, it turned it into a regular loan, required to pay it back with interest. This, you're required to just turn the money back over if you don't spend this money. How does this work? Yeah, go ahead, Liz.
Sorry. Can the money be used to for a new revenue stream?
Yeah, it's not designed for a new revenue stream in general. This is to keep your existing venues open. It is to provide money for payroll, but also any construction, for example, that would increase the ability to use the restaurant or other venue, like outdoor seating, things like that, but not really designed for any kind of expansion or improvement other than those related to COVID. As I said earlier, the process, it's the same as the shuttered venue operator grant. So this is going to require you to go directly to the SBA, and the SBA first order of business, they're going to want a DUNS number. If you don't have that, every business should have Dun & Bradstreet number, and they're going to ask you to register with the federal system for award management. If you haven't already done so, that's something that you can do right now. Even though money is not yet available, you can get your ducks in a row, get your DUNS number, get registered at the sam.gov site. And most importantly, and probably most time consuming, would be to get your supporting calculations, your P&L, your tax returns, get those all ready so that on day one, you can be the first in line as soon as the program opens, especially if you're going to be one of those lucky eligible people for that 21-day window. That's going to be opening up very shortly. So get your tax returns done for 2020. If you haven't done that, Steve will give you a quote today. Get your P&Ls done. Get all the supporting calculations you need ready to submit as soon as the program opens. How does this work with the PPP loan? So I got an example here, and imagine this is my example here is Steve's Steakhouse did revenue of $5 million in 2019. In 2020, revenues dropped to half of that, $2.5 million. Steve got a first round of PPP money of $500,000 and a second PPP draw of $800,000. So what is the maximum grant amount that Steve will be eligible for? So we start with his 2019 gross revenue, $5 million, subtract his 2020 gross revenue of $2.5 million. His total pandemic loss is therefore $2.5 million. So to calculate the Restaurant Revitalization Fund grant amount, we're going to subtract the first round PPP money, his $500,000 got in the first round, subtract the $800,000 draw, the second round of PPP. The maximum Restaurant Revitalization grant amount that Steve is eligible for is therefore $1.2 million. And that's basically what you need to know in terms of coordination with the PPP. Now, if that was all you needed to know, it would be a very simple calculation. Good and bad is the fact that we've got all of these other programs running together. The good news is many folks are eligible for more than one program. The challenge is that it does require a bit of coordination and calculation. That's where Steve comes in. He's going to help you get the most money from each one of these programs.
And what I'd like to say there is that there's so much coordination. For example, one of the things you might say is, well, wait a minute, if the SBA portal hasn't opened yet, what's the big rush? And the answer is we need to have everything ready, our tax returns, our financials. They're still working on this, but we have to be Johnny on the spot. I'm not kidding. There's not nearly enough money to go around. And it was like when the PPP first came out, the government said, don't worry, there's plenty of money, and boom, a few days later it ran out. It ran out even faster when they did it the next time. So the bottom line is we need to have all of these things ready so we can respond instantly to it. Again, this is going to be like a table of food placed down in a group of starving people. There's not going to be enough to go around. It's going to be a wild, mad rush. Furthermore, we have to be careful because what if you got PPP money and there's other programs? So we have to coordinate everything. That's why it's so important to be ready, because when your neighbor is looking at his information and trying to dig this and that out, and you've got your money and they've run out, you don't want to be that one that ran out of time and didn't do it fast enough. That's why we have to be ready now.
Yeah. We've got a couple questions here. So, Steve, what about draft tax returns? Somebody's got a draft of their P&L, a draft of the tax return. Is that going to be sufficient, do you think, for the government to make this application happen? Or are you going to need a filed tax return and a final P&L?
I'm going to guess, and it's purely a guess because this is a game where they're still making up the rules before the kickoff. I'm going to guess that a draft is going to be acceptable. And the reason I'm guessing that is people are hanging on by their fingernails. And there are people where literally a day, a week, a month could make a difference between staying in business and keeping open your life dream, or going out of business, having no idea how to pay this mountain of bills. And the bottom line is that I think they're going to accept estimates, because a lot of these things are going to be good faith estimates. And that I'm going to guess is going to be okay, because the portal is going to open long before the due date of the return. Furthermore, you have to be ready for all the type of questions. And again, I can't stress how important it's going to be to hurry up before somebody else gets the money.
Got a question, Steve. If somebody had an NOL in 2019 or 2020, you got a potential carryback, do you think that's going to affect their eligibility for this grant?
I'm going to guess again, and I'm going to guess no. And the reason I'm guessing no is the grant was based on gross revenue. Gross revenue has nothing to do with an NOL. So again, the whole idea of this program was to help out American business. So again, they're still making up the rules. That's my best guess.
And it's a very good question. So what a lot of businesses, a lot of people that I'm talking to, Steve's talking to, don't realize, if you had a loss in 2019 or 2020, you have a window now where you can carry that loss back to your profitable year. So if you had profitable years, any of the 5 years preceding 2019, get a loss in 2019 and 2020, potentially take that NOL back up to 5 years and get yourself a refund. So also look at that. So I think you're right, Steve. I don't think the NOL would disqualify you. I think it's also another opportunity for a tax refund that you don't want to miss. How does this work with the employee retention credit? So employee retention credit's a refundable credit you can claim on qualifying wages, including your health insurance. Just recently, in March of this year, Congress has extended the employee retention credit through the end of the year, through December, and it can be taken retroactively back as far as March of 2020. Now, with that said, most people took the PPP, and because you couldn't double dip, most people ignored the employee retention credit for the last 3 quarters of 2020. Now, this year, Congress has changed its mind and is going to allow you to be eligible for both the employee retention credit and for the PPP and the Restaurant Revitalization Fund grant. However, you can't use the same money for the same expenses. So you'll be limited. In other words, there's going to be some calculation here. It's not rocket science, but it's also not really a back of the envelope calculation either, how to maximize the total benefit coordinating these programs. So what we're doing, we're having people on a Zoom call or phone call. We can walk you through the various options here, but the big picture is you want to make sure that you benefit from all of these programs if you can. So the PPP money needs to be used at least 60% for payroll. That leaves 40% that can be used for non-payroll purposes. So last year it didn't make a big difference if you used it all for payroll or 60%. This year it makes a huge difference, because if you leave some money available to cover payroll, you can potentially be eligible for the employee retention credit. So if, for example, you use 60% of your PPP money for payroll, use 40% for rent and utilities and paying Steve's bill, you can be eligible for the employee retention credit. And Steve's going to tell you the difference between a credit and a deduction, but it's a big deal. It can make a very, very big impact. And because it's a refundable credit, that means all eligible employers can go back and amend their fourth quarter 2020 payroll tax return 941 And now, if you haven't filed for the first quarter, you can include the employee retention credit in your first quarter payroll calculation. Or if you've already filed for the first quarter of 2021, you can file an amended 941X and claim your refund that way. But this is, again, this is free money. This is, like I said, not rocket science, but it does require a few calculations. So,
And let's understand what a big deal it is. The difference between a credit and a deduction is this. A deduction, you have the benefit of your tax bracket. So even if you were in a 40% tax bracket and you got $100, you'd only save $40 in taxes. With a credit, it's dollar for dollar. So if you get a credit for $1,000, you save $1,000 in tax. And yes, we can go back and there's a different rule between 2020 and 2021. The 2021 is far more generous. The 2020 is only giving you $5,000 per employee for the year. 2021 is $28,000. So if you've already filed, and this is so new, the IRS had to revise the 941 3 times in order to do this. But that's okay, the form's available and we can go ahead and amend and get that money back. But also the government, and they're giving away the store here, they said, you know, you can keep the cash and not pay the appropriate payroll taxes by using another form. So that means, suppose I'll make up a number. Suppose you're entitled to $100,000 back in credit. And you say, well, this quarter I have to pay the IRS a check of $30,000. You can say, IRS, look, instead of writing you a check for 30, I'm going to use 30 of my credit. So I'm going to give you 0 for this quarter and you just give me back 70. Very powerful stuff. And also one of the things that we want to stress to you is all these things have to be coordinated. How you use the PPP money, the ERC, the Employee Retention Credit, the Restaurant Revitalization Act, and other things too. Obviously, we have limited time in a webinar, but there's other things that we have to consider too, and other government benefits.
All right, so just a little history here, just for some of you who haven't been following this as carefully as maybe we have. There are several versions of the employee retention credit. So under the CARES Act in 2020, employers who qualified, it took a loan under PPP, the credit was allowed to be claimed up to 50% of qualified wages on the first $10,000 per employee between the beginning of the program in March 2020 and the end of the year. So as I said, that is still open. That fourth quarter is still open if you're eligible. In other words, if you had qualifying wages that weren't paid with PPP money, you can go back and claim a 50% credit up to $10,000 per employee for that fourth quarter. Then we had a change with the Consolidated Appropriations Act in 2021. And this bumped up the credit to 70% of qualified wages. So that was a nice change. And it also applied to the first $10,000 per employee. And under the Consolidated Appropriations Act, that was scheduled to end in June. So that was for the first 2 quarters of 2021 under the Consolidated Appropriations Act. Under the American Rescue Plan, which just rolled out last month, the 70% credit was preserved. So that's going to be a maximum of $7,000 per quarter, but it's been extended through the end of the year. So that's going to apply to all 4 quarters of 2021. That's a nice credit. That's up to $28,000 per employee. Now, again, requires some coordination with the PPP money, because if you pay that payroll with PPP money, guess what? No credit. So you want to make sure that you're maximizing the credit by allocating some of the PPP money for non-payroll expenses. So can a business use the RRF grant for payroll and claim the credit? Well, there's no double dipping. So eligible payroll costs don't include qualified wages used to obtain the employee retention credit. You can still claim the ERC credit for 20 and 21, but the wages used in calculating the ERC can't be paid with grant funds. It's a limitation, but it just requires a little coordination and tracking here to make the most of both programs. So who's going to qualify for the employee retention credit? That's going to be any employer carrying on a trade or business which has suffered significant decline in gross receipts and or is suspended because of some government order. How do we calculate the gross receipts for the employee retention credit? So that's going to be the receipts of the taxable year net of returns, generally not reduced by cost of goods sold. So that's obviously an advantage for those of you in retail or selling goods in addition to services, and for restaurants in particular. So gross receipts do, however, include investments such as interest, dividends, rents, and royalties if you were fortunate enough to have some savings in investments or in a interest earning account. Significant decline for the purpose of the employee retention credit. Gross receipts, we start with the first calendar quarter in 2021 in which the employer's gross receipts are less than 80% of the gross receipts in the same quarter in 2019. So we don't look to 2020 this year. A significant decline for the purpose of the employee retention credit for 2021 is going to be a comparison with 2019. So for almost all restaurants and other eating establishments, bars, etc., that's going to be a pretty easy threshold to show that your gross receipts are not more than 80% of what they were in the same quarter.
And also, don't get hung up with the title of this act, Restaurant Revitalization Fund. You don't have to be a restaurant. And you say, well, what if I'm a bar, tasting room, food truck, food stand, but also they specifically left the definition wide open. It talks about an establishment that sells food and beverage to the public. So what if you were a bakery? Does a bakery count? I would take the position yes. And then if you have any type of business that's selling food or beverage to the public, even if it's, I'll call it non-traditional, at least talk to us and say, do we think you fit in here? Because, I mean, again, folks, do you understand this? The government is giving you your COVID gross revenue losses up to $10 million. And here, the I'll call it restaurant, et cetera, area has been singled out. There's some other things that were singled out, like the performing arts with the Shuttered Venues Act that Cliff was talking about earlier. But the bottom line is this is a tremendous opportunity. And that's why I'm saying to you, when the gate lifts, when the bell rings, this money is going to go in an instant. You got to be ready to apply, or what a shame if you get left out. That would be a crying shame. Cliff, back to you.
Thanks, Steve. Now, Steve and I do a lot of planning for clients with retirement programs, good times and bad times. Want to introduce another government program that was beefed up this year. And certainly if you can afford it, it makes sense to set up some kind of retirement plan this year. Under the Secure Act, you've got a potential credit up to $15,000 to start a new retirement plan. Now, some of you are thinking, well, my gosh, I'm barely making ends meet. How could I possibly afford to set up a retirement plan this year? But the government is creating a major incentive. They're paying essentially all of your startup costs to set up a new retirement plan. How do you claim that? If you've got less than 100 employees who received at least $5,000 in the preceding year, and in the 3 years before the first year you're eligible for the credit, your employees weren't substantially the same who received contributions, that is going to limit you. But certainly for most of you, you are very likely to be eligible for this credit as well. It's going to be eligible for 401k, for profit sharing, defined benefit, cash balance plan, which Steve will talk about a little bit, ESOP or annuity. So essentially any of the typical plans that a small business would consider are going to be eligible. Certainly if you have the money this year to set up a plan, it's a good idea to do so. Steve, did you want to talk about retirement plans at all?
I love talking about retirement plans, and there's so much to them. When people think about retirement plans, they normally only think about what I call the simple ones. What everybody knows about 401k, SEP, IRA, and they're fine, and there's nothing wrong with them. But they're so limited, and what most people don't know, there's over 20 different types of plans, and I classify them in two different groups: the simple ones that I just mentioned, and the fancy ones. The fancy ones, you can put away a tremendous amount of money. Our average clients that have these put away hundreds of thousands of dollars a year for themselves. And some clients even put away seven figures. And there's all kinds of benefits. One, you get a tax deduction. So you have to ask yourself the tough question: would I prefer to A, pay less taxes and put money away for my retirement, or B, pay more in taxes and not have the money for retirement? After you get the answer to that one, the next question is, would you prefer to put your money where somebody can grab it, like if you get sued and you're in business, and let's face it, people get sued all the time, and you could also lose it if everything goes bad, if you file bankruptcy, or there's special protection with ERISA protected plans, meaning that if you get sued and there's a judgment awarded against you in excess of your insurance, the plaintiff can't touch your pension. And although I hate to mention his name, O.J. Simpson is the poster boy for this, because O.J. has a multi-million-dollar judgment against him, but he's not paid one penny of his pension. He's not lost one penny of his pension. And also, if everything goes bad for you and you wind up going bankrupt, and again, with COVID, there's a lot of people that never thought they'd be inside a bankruptcy court. They're going to find themselves there. Not to mention the bankruptcy laws have changed far more favorably towards debtors. You would get to keep 100% of your pension in unlimited amount, which means if you do get sued, there's a great chance that your attorney can work out a sweet deal for you and you won't even have to go bankrupt. So there's so much that can be done here. The bottom line is these retirement accounts are fantastic, and we have a whole separate section where we counsel about these. Cliff, back to you.
Thanks, Steve. So let's just answer a couple questions here. The questions are coming in, which is nice. With regard to that 21-day priority window, if a business is owned by men and women, is that going to qualify for the priority now, this is my hunch, is that it's going to have to be a majority owned woman business. I think, a minority ownership by men is not going to qualify, but I think it's going to be required to be majority owned by women.
My guess is right there with you. My guess is right there with you. If it's like so many other benefits, there are other benefits for women-owned businesses. They have to be 51% or more. So I can see a lot of these. Not to mention, I would think that a lot of husband and wife businesses are like this. So again, you want to get in line as early as you can.
Are there going to be restrictions on owners' salaries? Yes. And so all the programs are slightly different, but the basic idea is you're not going to be able to pay all of the salary to the owner and to the owner's kids, right? The family members, related parties, there are going to be severe restrictions on that for the ERC and for the other programs. That said, owner's salary does qualify, as long as it's reasonable, and for the credit, if it's up to the 10,000 per quarter, will be eligible. Now there's some debate there regarding majority owners. So I've heard both. The regs are a little unclear as to whether for example, if it's 100% owned business, will the owner's salary qualify for the credit at all? I've heard arguments on both sides. If you're a minority owner, if you own less than 50%, absolutely. And there's some debate for owners who own more than 50%, whether or not their full salary is going to qualify. Another question: can we apply to multiple lenders and see who pays us first? So it's different. This is different from the PPP. This is a direct application with the SBA. There's no bank intermediary for the RRF grant, so that's a little bit different. What else? When will the SBA portal be open? I don't know that they've announced a date yet. It's any minute, so make sure you're checking that daily. When the bell rings, it's going to be off to the races. Just a little bit more on setting up a retirement plan. The startup expenses are covered. The cost to administer the plan, of course, is covered. And educating your employees. If you hire a specialist to come out, somebody independent, to explain how the plan works, that's going to be covered expense.
And also, the government gives the credit to the person setting up the plan for you. So even there, the government's giving you money there. And you say, well, why is the government being so generous here? Remember, if you don't take care, everything's an incentive in the tax law. If you don't take care of yourself, the government's stuck taking care of you. So they're giving you these incentives. But you have to know about them. And a question that I get all the time is, Steve, how come all these big companies get all these benefits? And we always see in the newspaper, Fortune 500s making billions with a B in profit and paying zero taxes. How is that possible? And one of the reasons I founded the practice over 30 years ago was because I said, you know what? Smaller businesses can take advantage of these too, but you have to know about them. And here's the example I give. Suppose you're sitting at your desk and I take one piece of paper and I put it on your desk and I say, if you take this piece of paper to the IRS, they're going to write you a check for $1 million. I'm willing to bet you'd go ahead, take that piece of paper to the IRS and get your check for $1 million. But suppose I put that same piece of paper on your desk for the $1 million, but then I back up a dump truck, dump 1 million pieces of paper on your desk, many of them looking like this piece of paper, and then drive away. What chance do you think you would find that $1 million piece of paper? You probably wouldn't. But the Fortune 500 have an army of guys like Cliff and Liz and me and the other members of the firm that know where that $1 million piece of paper is. That's part of what we do when we come through the Internal Revenue Code and say, here's all these benefits for you. Cliff, back to you.
Thanks, Steve. So here's a really good question from Tony. Are you going to be eligible for any of these programs if you're profitable? Or is this just to prop you up if you're unprofitable? So the answer is yeah. So as long as you can show decline in revenue, it's not you're not required to show a loss. You're just required to show a significant decline in revenue, and it's slightly different for the different programs. But in general, if your revenue is down anywhere from 20 to 50%, you're going to be eligible for some or all of these programs, even if you are still managing to turn a profit. So again, the retirement plan is eligible for credit. This is going to be up to $5,000 total, and that is for the first 3 years of the retirement plan. Let's duplicate. And it's, as Steve described, a credit is so valuable because it reduces your tax on a dollar for dollar basis. So this startup plan credit for the retirement plans, similar to the employee retention credit and other credits, is you apply for the claim using an IRS form. In this case, it's 8881 for small employer pension plan startup costs, and you will receive a refund for any refundable portion. A quick example here: plan has a startup and administrative cost $6,000. How much credit are they eligible for? So it's 50% of the total. The plan has 20 lower compensated employees that are eligible. Be 20 times 250. So that's they're going to qualify for a $3,000 credit. If they had only 5, then the credit would be $1,250. And that's, as I said, that's eligible for 3 years. Like all of these credits, you don't get a deduction if you claim the credit. So whether we're talking about the employee retention credit or the retirement startup plan deduction or credit, you're not going to get to deduct the same expense for which you claim the credit. And a couple of other government programs we want to talk about are the credit for the small employer health insurance premiums. So 50% of full-time employees say that health insurance is the most significant benefit they receive. So certainly this should be on your radar if you can possibly afford to pay for the group health insurance for your employees. Should be doing that. This credit covers up to 50% of the amount you pay toward the premiums for 2 years. if you have fewer than 25 full-time employees and paid less than $51,600 a year. And if you're funding at least half of the health insurance premiums. Another credit that's available. Some of you restaurant owners have built disabled access. You are eligible for a government credit there for the construction of ramps, wheelchairs, any text that you have. It's in Braille, accessible dining rooms, restrooms, removing barriers. Those are all eligible for the disabled access credit and covers 50% of your expenses up to $5,000.
And also on a slightly different topic, don't forget all that money you spent building those outdoor enclosures. I've walked past restaurants where I see they basically built another structure outside. They left the side one side open and said, here you go, it's outdoor dining. All those things cost money. You have advantages there too.
Yeah, and so for most of you, you would have thought you could deduct those expenses, which is correct. But again, we want to take a careful look to see if you're eligible for credit, because a credit is much more valuable than a deduction. And so that's why we're focusing on these credits, because they put dollars in your pocket above. So typically we're talking anywhere from 3 to 5 times what a similar deduction would be worth. Most of you restaurant owners know about the work opportunity tax credit. This is a credit that's available if you employ veterans, disabled veterans, voc rehab referrals, ex-felons, summer youth in empowerment zones, and food stamp or SSI recipients, the long-term unemployed. And you can save up to $9,000 over a 2-year period per employee. It's $4,500 a year per employee if you are able to employ these folks. Family and medical leave credit. So businesses who provided paid family or medical leave for employees are eligible for the family and medical leave credits, can cover anywhere from 12.5% to 25% of what you paid your employees. Must have been at least 50% of your pre-leave wages. So again, we're going to want to look at all the money that you pay out in terms of payroll or leave, and make sure that you're coordinating all of these programs, because what you don't want to do is leave any money on the table. And as we've harped on today, you want to make sure that if there's a credit available, you want to use that versus a deduction.
And Cliff and Steve, how can you just walk through the process? We're getting short on time here. I wanted to make sure that you could walk through the process on how people should contact us, and then what to expect. How much time does it cost? What is our how much time does it take to actually get the package to be submitted? And then also, what's our fee structure, and what can they expect?
Yes, those are very good questions. So just to reiterate,
they are, and
we've covered
what
this
we would
already.
say is, as far as contacting us,
Go ahead, Steve.
You can call us or email us or text us, and we'll get right back to you. And I talk with a lot of the clients personally, and if I don't, there are other firm members. And then what we'll do is we'll say, here's what you need. And in almost all cases, we do things on a flat fee basis. And the fee depends on the complexity of the work. Obviously, if you're a very large restaurant, the fee would be most likely different than if you're a mom and pop, but it'll be reasonable fees. We haven't been around for over 30 years by doing anything else. We also understand the urgency here. And it's not just urgency of the money's going to run out. The urgency is, and as a small business owners, we understand this, people are hanging on by their fingernails. It's like drowning. If that lifeguard doesn't get to you quickly enough, it doesn't matter. We understand that. And Cliff, what would you like to add to that?
Yeah, thanks, Steve. So just to get back to Liz's question, how do you get going on this? Well, we would want to help you put together your tax returns, financial statements, and other calculations at minimum for the Restaurant Revitalization Fund application. You want to get going on that right away. We can also help you with the employee retention credit calculation and filing amended payroll tax returns if you're eligible for those. In terms of timing, typically on an amended return, we're looking at a couple weeks turnaround time. Same if you've got your P&L all together, typically we can turn around a tax return in a couple weeks. So that's why Steve is pushing everybody to get their ducks in a row, because if you need your accountant's help, it's probably going to take 10 days, 2 weeks to get your documents together. You want to have this all ready to go when the starting gun is fired. So that is what you need in terms of fees. Steve charges a flat fees. I don't know, Steve, you want to talk any more about your fee structure?
What I'd like to say about the fees is I'd like to think that they're reasonable fees, and it depends on what we have to do. Depending on taxpayers, there is a wide variety of what has to be done. Some people come in and they're very well organized, and we only have to do a small part of the case, in which case the fee is small. On the other hand, somebody says, well, I've been meaning to get my records together for the last few years, and I have a bunch of 30-gallon trash bags filled with papers. I'll drag those in. I think they're the last several years, and my friend also is storing some other papers for me. I'll have him drop them off. That fee is going to be much larger because a lot more work to be done. So basically what I'd say is it's a reasonable fee for what you have. That's why it can so vary, like anything else. How much does anything else cost? It depends on all the facts and circumstances. But I'd really like to think after 30 plus years that the fees that we ask are really reasonable. Furthermore, you have essentially a discount on the fees because so many of these are similar to so many others that we've done. So we pass along the economy of scale. Most lawyers, before they do anything, say, well, I'll have to do the research. In most, not all, but most of the cases we do, they're so similar that we don't have to charge you that. We already know how to do it. We just charge you for doing the work in most cases. Cliff, back to you.
Thanks, Steve. We just have another minute. So if Liz didn't have any other questions, I would just point out here's the slide with Steve's contact information. Can people email you directly at your steve@moskowitz.llp.com?
Absolutely.
Is that a good way to reach you?
Absolutely.
And the 415-394-7200. That's a good phone number for you.
Absolutely. And we'll look forward to talking to you and helping you.
Great.
Right.
Well, thank you, Steve and Cliff. That was very informative. And thank you, restaurant owners, for attending. And we hope that we get to meet with you soon. Thank you very much.
And thank you, Liz, and thank you, audience.
Thanks, Liz. Thanks, Steve.
Bye-bye.
Bye-bye.